Hi traders, welcome to Market Outlook, Trends, Risks, Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30, 40 minutes or so. We'll look at the CME Fed Watch tool. We haven't looked at that for a while, just touching upon where Fed Fund futures are predicting rates will be in June and going forward after that for the next few meetings. We'll then look at some of the stock market indices in the US, namely the S&P 500, the Dow, NASDAQ. NASDAQ very strong, looking quite bullish. We've said that over the last few weeks. We'll also look at the DAX, the German index, which hit intraday and closing record highs last week. We'll then just quickly review last week's key main data points, probably US retail sales. We'll look at UK jobs and some of the Aussie data before then getting into the key data points, risk events for this week. Obviously, it's all about the debt ceiling, but aside from that, some of the data points will be of interest. So that's the US core PCE indicators. That's the Fed's favored inflation gauge. We'll look at UK CPI, a big data point for the Bank of England ahead of its June meeting, although we do get another CPI report before that meeting, remember. We'll look at the RBNZ, that meeting on Wednesday. So we'll look at the Kiwi against the dollar and then hopefully wrap up with Eurozone PMIs, important data for the ECB. We'll look at Euro dollar and just general expectations around the ECB. Okay, firstly, let's get to where markets are currently. Just bear with me 1 second. Yeah, so markets currently pretty quiet. This is the VIX, actually. You can see very low levels. We've highlighted this over the last few weeks or months. Long-term average around 20. We're below that substantially, really 17 or so. So very low at the moment. Volatility at the moment, yeah, in stocks, in the S&P 500, this is the VIX, obviously measuring volatility out for the next 30 days or so in that major benchmark blue chip index. Yeah, stocks generally mixed at the moment. Markets kind of cautious, front of mind. As I said, the debt ceiling clock is ticking and creating jitters really about defaults. There was a partial breakdown in negotiations on Friday. That sort of slightly ramped up concerns. Reconciliation and new staff level talks actually then happened over the weekend, just gone, keeping hopes alive that President Biden, of course, and Speaker McCarthy will reach an agreement by the end of this week. Progress on talks had been prompting some re-rating of US growth expectations, actually. And paired with hawkish comments by some Fed officials, markets were shifting towards a slightly more hawkish set of expectations for the near and medium term. However, of course, volatility in the debt limit sentiment also means volatility in rate expectations and the dollar. That is obviously key for this week, although there is a kind of cautious optimism really about a deal as we get to the brink. We've said it before about being these negotiations being all about brinkmanship really, and things potentially need to get worse in markets, say, to alert policymakers to reach an agreement. But that is generally, I think, consensus seen as expected to see a deal by the end of this week. I think interestingly, we'll just show you, yeah, CME Fed Watch tool. So this just shows you Fed funds futures for the specific Fed meetings, the FOMC meetings. So next one, 14th of July, June, sorry, apologies. Then 26th of July, then not two until the 20th of September. So nearly 2 months or so, 7 weeks, a gap during the summer. Then you get November's and then mid-December's. FOMC meetings this is. Yeah, I just wanted to mention these comments out of Fed Chair Powell actually on Friday, quite important. They brought back really expectations for the June rate hike, which had actually climbed to around a 40% chance of another 25 basis point hike at that mid-June meeting. You can see what Fed Chair Powell's sort of comments did. They brought it back actually closer to 10%, and we've just sort of risen slightly, I think, over the weekend with this slight reconciliation in the debt ceiling talks. Powell, though, just going back to him, he started his discussion saying inflation is far above its target. And the Fed is obviously strongly committed to returning to the 2% goal. However, he did note subsequently that policy rates may not have to rise as fast as otherwise due to tightened bank credit conditions. And we mentioned this over the last few weeks quite a lot. Data is obviously key for policymakers. Powell then added actually that, again, the risk of doing too much versus doing too little are now actually becoming more balanced. So interesting comments, we thought definitely worth highlighting that. Just looking ahead, potentially, if we do get a debt ceiling deal, then what Fed Chair Powell is currently thinking. Of course, all in, given kind of the recent positive short-term reaction of the dollar to progress on any debt ceiling news, and assuming, as I said, the stalemate finally gets resolved sometime this week, then the dollar potentially could be supported, especially given some of these key data releases we will get this week, could potentially bolster, really support slightly more hawkish repricing of Fed expectations then. So this sort of 17.9% then goes back up to, say, that 40, sorry, not as high as that, but higher than where we are currently. Bearing in mind, of course, though, what Fed Chair Powell has said. Also, I think we have to look at risk sentiment as well, whether that kicks on. The NASDAQ we'll look at very quickly has kicked on, but whether then other risk sentiment measures are helped by this this resolution in the debt ceiling. As for stocks, let's just pick up on the S&P 500. Yeah, they slid slightly Friday. Nothing major, very small down move on Friday. But yes, obviously around this impasse in the talks, slight nerves as well actually resurfaced about the health of the US regional banking sector. I think Treasury Secretary Yellen was on the wires talking about potentially more mergers having to happen in the US banking sector. That sort of slightly brought back those fears, as I said. The benchmark S&P 500, that closed modestly lower then, but actually gained on the week 1.7%, while the tech-heavy NASDAQ, that fell again very modestly, but chalked up its fourth straight week of gains, a 3% advance last week. Then going forward, of course, this week, we still get some results. The most monitored, the most looked out for will be NVIDIA's on Wednesday. That's the giant chip maker, of course. That share price jumped around, last time I looked, around 120% this year from its lows, though very early lows. Yeah, sorry, in early January, those lows, and then one-way traffic, one-way up move in NVIDIA's stock, one of the biggest winners within the S&P 500 this year. Really expectations by investors very high for the company's really advantageous position in the rapid development in AI, of course, and then the resulting demand for computing power. We also do get actually Lowe's, that's a big retailer in the US, other discount retailers as well in the US, Best Buy, Costco, reporting this week. So be quite interesting for a better gauge about the purchasing power of US consumers potentially. As for technicals, and we'll look at US retail sales actually shortly. As for the technicals, S&P 500, this is the chart. Again, we always like to go to the weekly, pulling that back out. We've highlighted this sort of bullish consolidation in a way last few weeks, but key level for us was 4195, so the previous January top. And you can see just pushed above just into it, really, just closed below it end of last week. So that close was 4191. We have that the previous January high at 4195. You also have got this light grey line there, which is the 100-week moving average at 4201. So again, key sort of resistance zones are around 4200. We just look as though we've got an upside break there, but really we need to close above it decisively, 4200 for more upside. If we just go to the daily, you can see, yeah, the push out of the sort of range. 2 strong days last week, Wednesday, Thursday, and then Friday just sort of hanging around that, couldn't quite push above it. So that's key for us still, that level, 4200. Most people actually in the markets, of course, watching that level as well. Otherwise, if we roll back over, then we go back into sort of 4100 in that range. Otherwise, more upside to come, potentially looking at sort of 4300. You can see the next upside fib level of this sort of down move from 2022 is 4311. That's 61.8 level. Kind of tallies with that mid-August from last year high, 4325 there. That's the upside in S&P, the S&P 500. As for the NASDAQ, weekly, again, we highlighted keeping, if we're holding above 12,880, sorry, which we have done, look, tracking sideways, kind of bullish consolidation, really. Did go on for quite a long time, but at least we held above 12,880, and then we pushed higher last week, you can see, and above the 100-week moving average at 13,438, that is now. So that will be, it looks like, strong support because that's the sort of breakout level as well. We then did highlight this high from mid-August again, 13,720, and we pushed above that and closed above it last week. So really interesting bullish price action for us. If we just go to the daily, you can see that 12,880 level holding, and then just edging higher before the nice sort of bullish momentum took us to above 13,800. You can see we're overbought now on the daily RSI, so we could see a pullback. Potentially, I think we put this in our weekly commentary, actually, potentially we get a sort of buy the rumor, sell the fact that if we do get a deal, then potentially we've seen all this upside. We could see a pullback, especially as we've sort of got above that mid-August high at 13,720 as well. Interesting point for NASDAQ then, whether we do see a pullback or not. For the Dow, interesting again, because well, old economy stocks really haven't benefited as much with this upswing in stocks driven really by tech, and you can see we're below sort of key recent levels, and we've still got it in there. That's well, mid-August high, which has capped the upsides numerous occasions, 34,281, that is. We have it anyway around that level, and we're nowhere near that, really, 33,426 at the moment. And you can see just sort of tracking around that, quite messy, really. Support around the 50-day moving average. That's the light blue line at 33,192, and then sort of 34,000 and 34,281 is the sort of resistance zone in the Dow. I said we'd just touch on the DAX as well. Really interesting. As I said, closed at a record high, 16,275. Also, we saw an all-time intraday high last week, beating the November 2021 intraday high. Fundamentally, well, earnings, especially strong in industrials, have done much better than implied by sort of the macro indicators. The DAX, yeah, it's gained 17% this week. This week since the start of this year. And kind of, yeah, low unemployment rates had made for relatively strong wage growth. And that's helping really firms pass on a large part of cost increases to retail prices. And that protects margins, and then has delivered surprisingly resilient earnings reports. I think we need to mention, of course, though, that certainly China's faltering recovery, and then also these tightening or tighter credit conditions potentially may warrant sort of concerns going forward. You can see we're on the RSI. This is, well, let's go to the weekly, see if we're overbought. We sort of ease those overbought conditions. You can see really nice bullish consolidation there, which we sort of, I think we've highlighted in the last few weeks, and then nice big push higher, but then testing these highs from November in 2021. Sort of inevitable, potentially nice break higher, then just to sort of pause in the bullish momentum. So we're not massively overbought still on the weekly. You can see that move higher on the daily there, and we're sort of touching overbought levels. So just to pull back on the DAX. You can see actually we've got a high of 16,355. So potentially that is to aim for if we do push higher. Okay, very quick review of last week's main events. We had UK jobs. We'll just touch on cable later on, actually, when we look at the UK CPI report. Just on the UK data very quickly, jobs report. That was, of course, wage growth was a key driver for previous week's Bank of England decision to raise interest rates further. The story kind of more benign now. The headline rate of regular pay growth, that notched up to 6.7%, but the level of average weekly pay actually only increased very marginally in the past month, and a slower pace than actually through much of 2022. And kind of the previous month now looks like a slight aberration. Elsewhere as well, we did get further signs that the heat is potentially coming out of the UK jobs market, albeit very steadily. The unemployment rate inched up actually to 3.9%, while we saw the first monthly fall in employment since early 2021. US retail sales, where were they? Headline retail sales came in beneath analyst expectations of 0.4%, compared some of the 0.7% decline seen in March. Although the headline missed, the internals were slightly more encouraging. Ex-autos, 0.4%. Ex-gas and autos rose 0.6%. Meanwhile, the control group, which feeds into GDP data, that was actually strong, 0.7% against 0.4% forecast prior, negative 0.4%. So all in, really, summary, the reports kind of showed signs of no immediate signs, of the consumer reining in its activity too much, although there are shifting consumption patterns suggesting slight caution in consumers, again, on banking concerns, and obviously these debt ceiling talks lingering as well, potentially having an effect, and really making consumers more discerning in their spending habits as the economy slows towards a possible recession next year. Just looking at the DXY chart here, just bringing the retail sales to a close, though. Of course, consumer spending accounts for about 2/3 of GDP. So where kind of the consumer goes, GDP goes, or GDP follows. And it's, of course, the resilience of the consumer has been a key factor in the unexpectedly strong post-pandemic economic performance. So it's kind of questions about how much longer that can last. I've got the DXY chart here. I might as well look at it now. We can see this push higher in the dollar, of course, breaking that long-term trend line sort of resistance. Now support comes in around potentially where 101.60 something or so, that support. We've kept in these sort of thick blue lines. That's the 200-day moving average, but the 100-day moving average potentially offers support in the DXY 102.87, and then you've got the light blue line 102.28 as further support as well. Highs, resistance, you can see 103.62 and 103.61 last week's highs. So that will offer initial resistance in the DXY. I said we just briefly touch on as well the Aussie data. We had first quarter wage data that offered enough really for the RBA to keep tightening policies potentially, despite not coming in at really, really high elevated levels. And then we had employment figures, which kind of possibly then complicate any plans to hike, because employment dropped in April, which then led to the unemployment rate rising from 3.5% to 3.7%. The details of the report, they were more gloomy as well, really. The drop was all due to full-time employment, while part-time hiring actually accelerated. There's very little actually priced in now in terms of RBA tightening. So you kind of think the room for Dovish repricing could hit the Aussie. That is kind of limited going forward. This is the Aussie chart, the Aussie against the dollar then, been in a range really for, well, since March. You can see top side capped at around spot 68 there, and also then the 100-day moving average, that's at 67.82. So that's some strong resistance. And then sort of bottom side, low side is around 66, decent support there in March and then in April as well. And then we had some last week as well in May. So 66, 68 range, you could play that with sort of, top side, capped by the 100-day moving average. Okay, moving on to this week. First of all, I'll just show you. First of all, yes, we'll look at US core PCE data. You can see on the chart here, it is kind of falling, but still pretty much elevated, and too elevated for the Fed. Of course, this week we'll focus on the debt ceiling drama, but economic data will kind of possibly take a back seat, really, be it something to focus on potentially if we get a deal. Then after that, of course, we did have, so better retail sales all in, lower than expected jobless claims last week, kind of continuing a slight sort of Goldilocks theme is what some economists are calling it. So we're not too hot in the economy, but not too cold either. And potentially that theme sort of continues this week. The Fed's the core PCE data that comes out on Friday. That's certainly the Fed's preferred inflation gauge. It's expected to confirm that we are seeing gradual disinflation, so that means falling prices. But as I've said here, inflationary pressures still remain firm, still remain above the Fed's target. Bloomberg consensus, just to take note, expects the core PCE to remain unchanged at 4.6% year on year, 0.3% month on month in April. I think interestingly, CPI data, so that's the consumer price index for April, showed core goods prices picking up, but disinflation in shelter. But we have to remember, shelter has a smaller weight in the PCE series than in the CPI series, so that should offset most of this, and so keep the monthly inflation relatively flat. Ahead then of the that data on Friday, we do get as well Fed minutes from the May meeting. That's released on Wednesday. The strength of the pause signal for June, as well as views around the debt ceiling concerns, of course, and the banking crisis will be key to watch. However, especially with Powell having reconfirmed his kind of inclination for a pause potentially, which he mentioned on Friday, contrasting against some of the more bullish, hawkish comments, signals we've seen last week from some of the Fed speakers. The minutes potentially will look a little stale, so just bear that in mind. This week as well, we do get, of course, more Fed speakers. We get Bullard, bullish Bullard, really, Bostic and Mary Daly today, as well as other speakers later on in the week. I've mentioned Fed funds, where they are, and potentially, well, that's sort of 17% or so, 20 chance of a 25 basis point hike in June. I should have really gone to the which let me get it for you. The December meeting is interesting, I think. So this is the end of the year, essentially. And we can see on this, if you haven't seen it already, so you can see where we are currently, 5 to 5.25%. So markets really sort of pricing in around 50 basis points of cuts by the end of the year still. And if we look at that number there, you can see it's been static, sort of 38% around a month ago. So interesting, 50 basis points of cuts. But if you just look below that, so 4.25 to 4.5, now 20% you can see, but that was a week ago, double that. So around 42% chance that we would have got, or we're getting potentially futures pricing in 75 basis points of cuts. Then that's being reined in. But as I said, for the near term for June, a hike has been taken out because of Powell's comments. Okay, that's sort of US way anyway for this week. Let's just check out then UK CPI data. That's also released on Wednesday, quite a busy Wednesday because we get the RBNZ, which we'll look at as well. So we get Wednesday UK CPI, RBNZ, UK CPI, German IFO, which we'll look at briefly after this, and then Fed minutes as well, all on Wednesday. As for the UK inflation data for April, this is headline finally expected to bid, actually could buy to double-digit prints that have been seen consecutively, for the last 7 months. So Bloomberg consensus expects headline to cool from 10.1% in March to 8.2% in April. The core, though, is still remaining firm at around 6%, 6.2%, I think. Just thinking about the prior report, that saw the headline CPI drop to 10.1% from 10.4 in February, but that was 0.9 percentage points, 0.9 of a percentage point above the MPC's forecast. So a lot of this slowdown that we see to 8.2%, that's driven by base effects as, of course, the massive surge in household energy bills from last year, from 12 months ago, that finally drops out. It will be more important actually probably to watch the strength of the services inflation print to indicate any sort of clear shift in Bank of England expectations for the June meeting. And you can see the chart here with the core, that's the light blue line, and then the thick dark blue line falling quite sharply now. As for the Bank of England, a 25 basis point hike is priced in, I think, around a 75, 76% chance of that. So around 19 basis points priced in. As I mentioned, actually, there is another CPI report and also a further jobs data before the June Bank of England meeting. So just bear that in mind. We also get retail sales, UK retail sales out on Friday. And it should shed further light on the consumer after really a depressed March print, suggesting inflation may be hitting consumers worse than some thought. Okay, just let's go to cable. Bear with me 1 second. 124.60 at the moment. I'll just go to the weekly first of all, try to ignore some of these lines. You can see these sort of 8 consecutive weeks of gains, really. And then that came to a halt. We hadn't seen that for a couple of decades, I think. 8 consecutive weeks. I think we were pinpointing 9, actually, which hadn't been seen since 2003. But you can just see we just sort of tapped possibly the that grey line, so that's the 100-week moving average, 126.78. Last week we got to 126.79 there, and then we sort of rolled over and fell down. You can see there, bobbling along. Looked like quite a nice consolidation, but didn't see a push up higher, and then we sort of fell down with that dollar strength. Again, we highlight 124.47, so that is the January high, very key for us, and because we were holding above it, below it, you can see over the last few months, and then sort of took a a leg higher, but then obviously with this move down, recent move down, we've sort of again trading around that 124.47 level. Support there you can see is the light blue line at 124.15. That is the 50-day moving average. So potentially we're holding above here again for a move higher. If we do lose that sort of 124.47, 124.15 area, the lows actually from last week, yeah, below that 123.91, 123.92. So strong support there. Otherwise, if we do lose that, then we're down to sort of 123 lower, sort of mid 123s or so. That is in cable. Okay, just on the Kiwi dollar, how are we doing for time? We're good, hopefully. Of course, I should mention if you do have any questions, then please do ask away. Always open to any questions you may have on what we're talking about or any setups you're looking at. Trade setups, of course, can look at that from a technical level as well, or any other fundamental areas you'd like to look at. Please do put those in the chat box. Otherwise, yeah, RBNZ Bank, they are likely to continue their tightening cycle. Money market's really pricing in a 25 basis point hike. That takes the OCR, so the overnight cash rate, to 5.5%. That is the highest in the advanced nations, actually, and would be the 12th consecutive rate hike. Just pulling back, actually, a reminder. So the RBNZ, they surprised markets at their last meeting in April, delivered a larger than expected 50 basis point rate hike, as 25 basis points really was consensus. And the language kind of remained hawkish. It stated that the OCR rate, so the cash rate, needed to increase, and the committee really agreed it must continue to raise that rate to return inflation back to the target band of 1 to 3%. Inflation we're seeing is still too high, persistent, and as well as viewing risks to inflation pressure from really fiscal policy being skewed to the upside. I'm just checking the committee, really, they, expect slowing demand, really, potentially a moderation in core inflation going forward and inflation expectations. But the rhetoric was still seen as potentially possibly a downshift in gears to a less aggressive pace of tightening at this week's meeting, but certainly a hike is still in prospect. Interestingly, I think data, more recent data than inflation expectations, they come in much lighter for Q2 than Q1, falling actually back within that forecast range of 1 to 3%. But then on the flip side, we've had the budget, latest budget update, really tipping the odds in favor of the rate hike going forward, and potentially one in the summer. Markets price that again for a 25 basis point hike in the summer, with quite a lot of fiscal support still to come. There is some speculation, possibly a chance of a 50 basis point rate hike for this meeting again. I think there's around a 20% chance, so just bear that in mind. That would give a lift certainly to the Kiwi, but it's all about, we do get updated forecasts, so that will potentially see some volatility, as I said, in the Kiwi, with just checking the peak rate actually in February that the RBNZ projected was 5.5%. So if we get 25 basis points now, that takes the rate to 5.5%, but potentially we're getting one more priced by the market anyway to 5.75% at least for the peak rate. So updated forecast by the RBNZ will be key for direction going forward. This is the Kiwi dollar, and you can see kind of stuck in a range, really, since March, around sort of 62, 61, the low side, really, and the high side sort of capped around 60, well, below 64, really. We've got this level in here, which is at 61, where is it? 61.91, which was sort of previous support in January of last year, and we've been just tracking around that really. So you can play the range. We've got the 200-day moving average at 61.54. That's the thick black line as probably strong support around that level. And then, well, the 100-day moving average potentially capping near-term support anyway at 62.72 before possibly, if we do push higher above that, then sort of 64 is the range high for Kiwi dollar. Okay, just quickly, we'll look finally at some of the euro stuff. So we got the euro dollar chart here. We do on Tuesday have flash PMIs. They could play quite a significant role in either putting a floor to this sort of euro slide that we've seen, or potentially deepening the losses in the single currency. For the PMIs, the forecasts really don't point to much of a change in the economic picture. In the Eurozone, manufacturing sector is still expected to contract again and below 50, while growth is really propped up by the services industries, that number being above 50. Certainly the recent batch of worrying German data has kind of instilled a downward bias to the euro. Amid, of course, the greenbacks, the dollar's revival. We get the German IFO business sentiment survey, I said on Wednesday, but we have had the ZEW, which is a business survey as well, being quite disappointing. As for other things happening in the Eurozone, really, and the ECB last week, well, we heard from we got quite hawkish comments actually from President Lagarde, kind of reinforcing the pushback against the notion of a pause by the ECB. She's speaking again actually on Wednesday, and then today we have had, do have quite a few speakers, Villeroy, de Guindos and de Cos speaking today, and there are other speakers going forward this week. So just watch the wires for those comments. I think markets kind of been ignoring really actually ECB speak for the moment because of the strength of the dollar, and markets really fully pricing in certainly at least one more hike in June, and then probably another 25 basis point hike by September. That kind of says to us it seems unlikely that, as I said, the ECB speakers at least can push short-term euro rates that much higher. Okay, euro dollar chart technically then, just bear in mind sort of we did have very stretched long positioning in this currency pair going into sort of the debt ceiling negotiations, and that has meant the pair was kind of vulnerable to corrections, and we've seen that, of course. You can see that here. If we just go to the weekly and pull it back, you can see just sort of bobbing up around the sort of 110.32 level. We've got it here actually 110.30, yeah, 32 from the January high. Couldn't break above there. We had then that weekly doji at the start of May, so sort of indecision, and then the sort of big move down that second week in May. Just pull it back. We sort of broke that near-term trend line support, and then sort of downtrend really we've got in here. Yeah, just short-term fib levels. And where are we? We're sort of on that halfway point of the sort of this year's move higher in the euro. That halfway point is 107.88. We did move below there, but similar to the DXY. So you've got sort of strong support around 107.59, 107.62 area. You've got the 100-day moving average as well, just above that at 108, sort of psychological level. So interesting whether we hold there or then move lower down towards sort of the next fib level, 107.16 potentially, if we do lose that support. Otherwise, then we push up towards sort of 108. Which sort of long-term levels, long-term sort of bullish momentum still probably holds for us in euro dollar. Okay, we will wrap it up there. Hopefully that's been of some help. Sorry, I did have an RBNZ chart there. You can see just sort of topping out their money markets, probably pricing in another 25 basis point hike, as I said, after this one, or whether we get a 50 basis point hike on Wednesday, and then we're sort of done by the RBNZ. Will be interesting, their statement and of course their forecasts. Okay, do follow us please on social media, and also on our website. We print a daily commentary which has a chart of the day and market thoughts, a day of the head, just fundamentals, technicals, which is on the website. Okay, good luck out there. A lot going on, and of course, keep your eyes and ears peeled about, of course, debt ceiling talks and any deal for this week. Okay, we'll speak to you next week. Take care.